This is Bite-Sized Business, the channel where we take company news and reports and simplify it down into a few important financial metrics and ratios to determine a company's financial health. In this installment, we will be taking a bite into Wendy's. The starters. Wendy's is a fast food company founded in 1969 in Columbus, Ohio. In 1970, a year after the first Wendy's opened, they opened the world's first drive-through pickup window. Wendy's now has over 7,000 locations in over 30 countries, and Wendy's serves approximately between 6 and 7 million customers a day. Wendy's sells staple products such as the Junior Bacon Cheeseburger, the Baconator, its famous Frosties, and its fresh, never frozen beef. The main course. Similarly to McDonald's, Wendy's earns income primarily from franchise fees and other franchise-based revenue streams, but it still owns nearly 7% of its global locations. In the last 12 months, Wendy's did $2.2 billion of revenue and $193 million of net income. Revenue is up $100 million from 2022, and net income is up $17 million from 2022. This represents about a 5% growth in revenue and a 10% growth in net income. Similarly, Wendy's EBITDA grew at about the same rate as its net income, as in the last 12 months, Wendy's has done $552 million of EBITDA and $500 million of EBITDA from the same time period 2 years prior. This represents, again, another 10% growth in EBITDA. I will get into why the EBITDA is so much higher than the net income when I get to the free cash flow statement. Wendy's balance sheet ending in 2023 shows total assets of $5.2 billion. This is up from $5.1 billion 2 years prior. Total liabilities sit at just shy of $4.9 billion, which is up from $4.66 billion from 2 years prior. This leaves shareholders with a total current equity of around $310 million. This is down sharply from the 2 previous years, where in 2022, equity stood at $465 million, and in 2021, it stood at $436 million. In the last 12 months, Wendy's has reported free cash flow of $280 million. This is up from $174 million from 2 years prior. EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is a metric used by businesses and investors to gauge the true profitability of a business. But it is often scrutinized as not being the real earnings of a business and just a made-up number. Wendy's EBITDA was $550 million and the net income was $177 million. This decrease of $380 million comes from $147 million in interest expenses, $75 million in tax expenses, and $160 million in depreciation and amortization. These numbers are from 2023, as these numbers are primarily only reported on end-of-year statements, and we are not quite to that time in 2024. Wendy's has repurchased $107 million of stock in the last 12 months, and this continues a trend that they've had over the last few fiscal years. If we take a look at Wendy's shares outstanding graph, we will see that just like McDonald's, they have bought back a lot of their common stock. Since 2010, Wendy's has bought back 55% of their stock, resulting in a drop of 459 million shares in 2010 compared to 200 million shares at the end of September 2024. In the last 2 years, Wendy's has bought back nearly 6% of their stock. Now for the dessert in the Excel sheet. The company we talked about today was Wendy's, who trades under the ticker symbol WEN. Wendy's is in the fast food industry and did $2.2 billion of revenue in the last 12 months. They did $550 million of EBITDA in the last 12 months, and that resulted in a net income of $194 million. They have $4.1 billion of debt and $5.2 billion of assets. They also have $4.9 billion of liabilities. This leaves us with a positive shareholder equity of $310 million. In the last 12 months, they have done $280 million of free cash flow and $107 million of stock buybacks. If we look at the ratios, we can see Wendy's has a high debt to equity ratio of 13.36, an equally high debt to EBITDA ratio of 7.49, but a high EBITDA margin at 25% and a strong profit margin at 9%. Buybacks were 38% of free cash flow and 55% of net income in the last 12 months. If we compare this to the other companies we have done, we can see that they have a high debt to equity and a high debt to EBITDA. Both of those are comparable to McDonald's, as the debt to equity is better because there is still shareholder equity, unlike McDonald's, and the debt to EBITDA is also high, in this case being much higher than it was for McDonald's, being around 2 times higher than that. They have a strong EBITDA margin of 25% and a neutral net profit margin of 9%. Based on these numbers, I decided to give Wendy's a yellow light because they are in similar financial standing to McDonald's, and while they're in a slightly better scenario in their debt to equity, they're in a slightly worse scenario when it comes to their debt to EBITDA. And the net profit margin of Wendy's isn't as high as McDonald's is to combat those high debt to equity and debt to EBITDA ratios. The check. The check is some of the drawbacks that a company might have. In this case with Wendy's, it is that they are planning to close 140 more U.S. restaurants by the end of this year. This is on top of the 100 restaurants it said it was going to close in May. The company says that the total number of restaurants should grow because they still plan on opening between 250 and 300 restaurants this year. This is a common occurrence in the franchisee model of business, as some locations just aren't as profitable as others, and so it's not uncommon to see turnover in some of these industries. That being said, closing 140 locations in the last 2 months of a year is not a good sign for the company. And while they are still seeing growth, this drop could show that maybe the same store sales that a Wendy's location is gaining isn't enough to offset the expenses that they have, and the franchisees have more lucrative business ventures elsewhere. Thank you for watching this video. If you have any comments or concerns, let me know in the comments. And if you have a company you want me to look into, please feel free to reach out, and I'll try to have a video out within a week's time. The next video that I plan on making will be ticker symbol QSR, or Restaurant Brands International. Restaurant Brands International is another large fast food service business, and so it will be interesting to compare these two companies. Restaurant Brands International owns Tim Hortons, Burger King, Popeyes, and Firehouse Subs. And so while unlike Wendy's and McDonald's, this company has multiple different income streams, it may be different because the franchisee structures could be different between restaurants. And so some of the numbers could be interesting. And it's going to be nice to get a wider variety of franchisee businesses within the food space. I hope you enjoyed the video, and thank you for watching.